Power chart patterns. This is part one, entering chart breakouts. Two type of early morning breakout patterns that we want to look at. The first is those that occur before 10 a.m., pre-10 a.m. breakouts. Here's an example with PeopleSoft. You can see PSFT. It's open at 9:30, made a small cup pattern, and we get in right here over the cup. Anywhere up in here, 42.2 to 42.5, and these are before 10 o'clock. Again, our round trip's going to be less than 10 minutes, 8 to 10 minutes on this. And these are for experienced traders who are able to route their orders accurately and quickly. For newer traders, wait till after 10. That's our second type of early morning breakout patterns, is post 10 a.m. breakouts. And you can see an example here with IDTI. That's a biotech stock. And you can see here it's sold off, consolidated, and didn't make its cut pattern till after 10 a.m. And that's the other type. So if you're just getting into trading or you're struggling with it, I'd wait until after 10 a.m. and play these slower moving breakouts. If you're a fast trader, you want to get in on the early morning ones that occur before 10. So that's two different examples of early morning breakout patterns you want to look at. In terms of trading consistently, I recommend that you practice with a variety of different stocks and limit yourself to the 2-day high breakout patterns initially. If you're having a tough time in terms of being stopped out or having a choppy trades, which we've seen a lot of this past 6 months or so, if you limit your trading to 2-day high breakouts, that's a strategy that I've found to be effective. Now let's take a look at the second bullet point here. Cut patterns, intraday highs, 2-day highs, and consolidation breakouts. First example here using eBay. Very easily defined cut pattern. You can see a couple of cups here on the 2-day chart. This is not a 2-day high. This would be a intraday cut pattern breakout after 10 a.m. Okay, you can see that on the open it sold off, consolidated, and didn't really get new buyers or a cut breakout pattern until after 10:45 or so, and that's fine. You can play after 10:30. Again, we always want to get out of our positions by lunchtime roughly, but this would be a later morning cut breakout pattern that you want to look at. In terms of looking at just intraday highs, that's interesting. But it's not sufficient to justify getting into a trade. Here's an example of Sun Microsystems. Just because a stock's making a new high of day is not enough to justify getting into many trades, at least in my own personal experience. You want to confirm that with a 2-day high. An example here, if we had been trading Sun from the open, you can see it opens at 9:30. It's starting to make a high for the day here. A newer trader, a less experienced trader, would go ahead and just buy that high. But if you put it in perspective, looking at the 2-day chart, you can see that's not really a strong pattern. You're not making a 2-day high here. It's not giving us enough signal to be worth trading. So if you look at instead a 2-day high pattern, that would be worthwhile, because you can see oftentimes they'll sell down and not really make a bounce until after 10, and not really make a cut pattern high until later in the session. So the point is, making a new high for the day itself is not enough. You want to look at 2-day highs as being the highest probability trading pattern. And again, a good example is with PeopleSoft. You can see here, you can certainly try and guess and bottom fish, but I certainly don't do that. I think it's better to have a trade confirmation for stock making a high over the previous day's high. And that's a good example from today. That's our entry here, over 42.5 or so, above the previous day's high. You could get in a little bit earlier on the first cut pattern breakout here, but again, if you wait for a 2-day high, that seems to be much stronger in terms of a pattern to get into. Okay, one of the next patterns we're going to look at is consolidation and consolidation breakouts, and how do those work? Here's an example with Biogen, BGEN. This is our half-day intraday chart. Consolidation is simply when the buyers and sellers disagree with each other, and it trades. What I like to see is if it trades in a narrow, choppy range on what's normally a multi-point trading stock. A stock, in other words, that has a 2 to 4 point range, and for the current time frame, maybe 15 minutes to half an hour or so, it's trading in a less than a half point range. It's a very tight range. That's typical to get a breakout. You can see even here, there's a a triangle pennant pattern here. And if you put the high-low consolidation, you can see a breakout over the consolidation is here up near 56 for a long, for it to continue getting buying. So again, consolidation breakouts, you wait until it makes a new high above the small micro support and resistance that it's currently trading in. If we look at, let's take a look at an example on a 2-day chart with QLGC. You can see here it got some consolidation right after lunch, and a breakout long would be above this support and resistance level to the upside, and you can take a quick half point out of that. Okay, another example, again, one of the good examples, Intel. And again, what you look for is after a long run, you look for consolidation, and you either short on a breakdown if it starts to fade back, or you go long on a breakout to the plus side if it gets new highs after the current trading range. So identifying these very narrow ranges is important to trading. Now this stock, Intel, again, this is not one I trade, but the chart pattern's good to learn from. If it had lost support here, this would be a short here on the downside because it might retrace down into the range here. In this case, it made a breakout to the upside, so the long signal's over the previous highs. Okay, now let's take a look at trade management for breakout trading, order execution, and timing tips. Just a couple of quick points. It's generally always good on a level 2 box to have Island highlighted, and also to open up an Island Java book, which you can get at the isld.com site, to take a look at what that entire montage looks like. You don't want to pay up on Island. I find that a lot of new traders, especially even with decimal trading where it's tighter, there's no reason to go try and sweep the order book and pay up 3 or 4 spreads. Maybe it's 15 cents, maybe it's 10 cents. I don't know what the 3 or 4 spreads out of market is. It depends on the stock, but you really don't want to be paying out of market on Island unless you really have to. You can go maybe 1 or 2 spreads out. You can make the market by splitting the bid ask or joining the bidders, but in terms of your timing, especially for breakout trades, you wouldn't really want to pay close attention to time and sales, and you might want to pay up or might have to pay up 1 spread or so on Island, but don't make it a habit. Don't always pay the ask. See if you can get a fill somewhere in between or within the inside market, because typically the stock will go up and down enough to get you a fill, and there's no reason to try and jump on it or pay 2 or 3 spreads out of market only to see the stock fall back and then take out a stop that you have. Another quick point, this is aftermarket, so the spreads are a bit wider than they normally are, but when you're trading, you want to use the red band, that is the 3rd or 4th spread out of market, as your trailing stop. You want to be no further than say 3 spreads out of the market for a trailing stop, and for a stop loss. Initial stop loss should be at the red band or so in your level 2 box. So that's something to pay attention to as you're managing your different trades. So the point is, don't hit Island 3 or 4 spreads out of market. You might want to just join the bidders here or split the bid ask. Okay, let's move on.